Hello, everyone. David Moore, Equity Advantage, and today is August 7th, 2025. So, always need to get those dates in there for future context. I've got a banana peel in the foreground here. I just thought it was sort of a good idea, reminder. You know, it's funny. I spend a lot of time on boats and eat a lot of bananas. And they're very good for you, but they're considered bad luck on a boat. I think it's up here today just because it's symbolic of you got to be careful, right? Don't step on it, you fall down. And 1031 is one of those things where you need to plan ahead, really take care of things, know what you're doing up front, and work to do the right thing because there are opportunities to blow a transaction up. And I think what I wanted to do today, we're going to take a couple of topics, break them down. But one of the things that came up yesterday, I'm sitting there talking to somebody, and they're looking at doing a deal, and they have owned a property for years, and they have just spent a pile of money getting it ready for sale. It was roughly $50,000. So the idea that, it's easy to have that happen, and I always laugh. You think about the old sofa with the vinyl on it, right? I mean, who are you saving the sofa for? You think about your home, and you think about all the work that's done to your home just to prep it for sale, and you didn't get the benefit of it through all that time you lived in it. So when you're looking at something like this, people ask all the time, when I close a transaction, what can I pay for? Or, I want to pay this fee, that fee, all these different things at closing. And it's not a black and white list. Anytime we're looking at tax issues, typically it's going to be gray. It's a conversation you want to have with your tax people. But we've put together a sort of a thumbnail of what we feel is something that's universally accepted as far as closing cost deductions. And things that we would consider normal transactional costs would be sales commissions, legal fees, finder's fees, escrow fees, inspection, testing fees, transfer taxes, title insurance fees, recording fees, property taxes. Things that would not be considered a normal cost: rent prorations, utilities, property liability insurance, points for a loan, mortgage insurance, application fees, lender's title insurance, assumption fees. And then we've got sort of series that may or may not be, and you sort of look at things that, another set that might be considered yes would be exchange or combination fees. Obviously, we're going to put ourselves in there. Messenger fees, try to do something with a lawyer these days without some type of messenger fee. They're document prep fees, statement fees, inspection testing fees, tax service, processing fees, notary fees, things that would be a definite hard no: homeowners dues, repairs, termite work, security deposits, replacement property loan acquisition fees. And, in today's world, we have lots of people that are paying down loans, trying to get a rate that's better. A maybe would be an appraisal fee. And that's one of those things where I would say an appraisal fee, in my mind, is always going to be good because, for most people, they're financing a purchase. You're not going to get a loan without an appraisal, but we've got people in the legal community that will say an appraisal fee is a normal cost if it's a contingency of the purchase. It is not if it's part of the financing. So just be aware that these things are not black and white, and you need to have these discussions with your tax people because they may or may not treat things a certain way. The problem is everybody comes back to us. So back to the guy with a $50,000 cost of improvements on this project just before a sale. Now, the property's not on the market, but they'd like to get the 50 out. And I said, well, the problem is you just put 50 into it. And if you're pulling 50 out at close, that's not a lien. That's not anything that's there. You're effectively pulling $50,000 out of the exchange, put in your pocket. So that is going to be considered boot. So really, if you look at it, the only way to get that taken care of would be to put a lien on the property, but that lien should be put on it in enough time prior to a listing for sale that it's seasoned, so it doesn't look like just a step transaction, for example. So you've got really two courses going forward. You've got one to put that cost on that property as a lien, but it's not, you can't personally have a lien on the property. So what I'd say is you probably want the vendors to have the lien on it, and two, it needs to be put on well enough in advance where it's not looking like a step transaction. So these costs are put in place. You're doing it all, getting it on, and then it's been seasoned before the property's ever been put on the market. I think you're still vulnerable there. So the other option is saying, okay, gee, that 50 would normally be considered a capital improvement with what they discussed having done to the property. So every dollar you put into a property, you either expense or capitalize it. If you expense it, you write it off. If you capitalize it, increases the basis on the property. So typically you'd say, okay, that's a capital improvement, increases the basis, which upon a sale would decrease the gain, and you'd have some tax benefit there. But the other side of it is, you're going to have tax exposure. So if we say, well, gee, these things really constitute expensed items, not capital improvements, then maybe, although if you took money out at close, you're going to have tax exposure on that money coming out as taxable boot to you, you're going to have tax exposure there. Maybe your tax people are going to look at it and they can offset the tax consequences the boot received by expensing the cost of those improvements in that transaction. So we see occasionally something that might be traditionally a capital improvement, we see it expense if it's part of that closing. And that's really a discussion of that you need to have with your tax people, because having tax exposure is one thing, actual taxes owed is quite another. And that I think it's a great example of why tax people are so critical in today's world, because as I said, you may have tax exposure, doesn't mean you owe the tax. So you've got to look at it and say, okay, I've got tax exposure here. How can I mitigate that tax exposure? Maybe we do it by expensing, or maybe we've got a situation by year's end. You're going to go back, circle the wagon, and say, hey, okay, I took 50,000 out to do this. I got 50,000 boot. I've got 50,000 exposure there. Maybe by year's end, you're having meetings, conversations with your tax people, your financial advisors. Maybe you've got losses somewhere else to offset the gains on that situation. So 1031's not all or nothing. Do what's going to be right for you. Don't make your life real hard and just say, gee, I have to hit these numbers. Otherwise, it just doesn't make sense. It's not always the case. There's lots of transactions where you might have some money that goes to something that's not a normal transactional cost. It's not going to kill your exchange. It may make your life easier. And if it does it, pay the tax on that difference. Go to bed knowing you're going to sleep well at night instead of worrying about all these things. So I hope that has clarified a little bit. If you've got questions on closing cost deductions, give us a call, because it is a slippery slope and we're always happy to help. We're not supposed to give tax or legal advice, but we're happy to get some information out so you can go talk with your tax and legal people and sort of hit the ground running with the issues that may or may not apply to your situation. Thank you very much. And 1031exchange.com, David Moore signing off. Thank you.